Mid-October, stocks have been on a green strike. This is the third day in a row, back to back, that the market is finally having, a green day. And this is one of the strongest start or the strongest month of October for stocks in the US marketplace. Now, for some people, this might be like, you know what, of course, it's a bear market rally. In other words, the market is still going to go down. We're just in a phase. But I want to show, some indicators in this video and share with you guys my opinion on why I think we can expect, a lot more room into this rally, into these stocks continuing to go up and go up and go up until maybe we see something happening, and that's maybe when you will start to get out of stocks in order to wait for the market to go down again and to scoop some shares, especially for your favorite stocks. But that is not something for everyone. It depends on your strategy. So let's get into all the details and see exactly what is going on here. As we mentioned, the month of October has been a stellar month. Again, today we are seeing that, stocks 1% for the Dow Jones and the S&P 500, even 1.6 for the S&P, and then 2.2% for the Nasdaq. And this is because of the rates, interest rate from the bond market that are declining. The dollar, which is the currency, which is the strongest currency as of today, as of now in the whole world, is also kind of declining. So whenever you have interest rates declining and you also have the dollar declining, it's a good recipe for stocks on the stock market to go up. Why? Because the money that is being transferred from the bonds is now going into stocks. All right. So we all know that this has a lot to do with people expecting what is going to come in the next Fed meeting. Because right now, we have a lot more people thinking that the Fed is going to increase rates 0.5% instead of just 3/4, 0.75%. And that is kind of bullish for stocks because it may mean that we are getting closer and closer to the end of the interest rates kind of, hike from the Federal Reserve getting to an end. All right. Because whenever it stops, whether it's a pause or, a complete stop, we can expect people to feel a lot more confident because they know what is going to happen in the near future. That's why the stock market hates uncertainty. So whenever we have a little more clarity, at least in the next 6 months or even the next 3 months, people feel more comfortable taking some more risk into stocks. And that's why we're seeing some green days as we're seeing now. Is it the end though? Is it going to be the end of the stock market rally because we're still in the bear market? If you look at the S&P, the Nasdaq, and the Dow Jones, we are still very, 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 very low than the height of 2021 and early 2022. So let's check into some indicators. I saw in a pretty interesting article, kind of thinking about 8 things investors need to know in a volatile market because we still may have some rally or some room in this bear market rally. So they're mentioning things such as, plenty of event risk facing markets, earnings being one of those, people being a lot more comfortable or kind of betting on a Federal Reserve shifting its message around what to do when it comes to fighting inflation with interest rate increase. And then we have technical analysis being part of that. We have, earnings season, which is not as bad as we thought. And then other things. Now, I want to look at something that came out today. All right. Today we had home prices cooling at a record pace since October, coming from Case-Shiller. So according to this S&P Case-Shiller, home prices are still higher than they were a year ago, but the gains are shrinking at the fastest pace on record. Prices in August were 13% higher nationally compared with August 2021. That is down 15.6% annual gain in the previous month. So if you look at the way the CPI is being computed, rent, shelter, and house prices, or shelter as a whole, plays a big part in that CPI data, which is giving us the consumer price index. All right. So oil since the last month have also been kind of steady somehow around the 80s-ish dollars a barrel, which is not too bad. All right. And then on top of that, we have, what we call the U.S. sentiment consumer. The U.S. consumer sentiment index, which is also declining severely since the month of August. So maybe just maybe, the Federal Reserve is going to look at these real-time data and consider the fact that what they have been doing so far by increasing interest rates aggressively is starting to finally work. I mean, 30-year mortgage interest rates are now kind of flirting with 7%. That's a lot because it prevents a ton of people from buying a house, from ownership in the real estate market. So as a result, prices are declining. And usually when prices decline, home prices decline, rent is also expected to follow suit. All right. So whenever you have that shelter component from the CPI data computation, it means that, hey, in real time data, inflation is going back down. So maybe we don't need to go all the way as we did, because what we've did so far is already somehow working efficiently. We just need to be patient. All right. Remember, inflation kind of grew up on us, not slowly. All right. We woke up a morning and then boom, it's 5%. And then from that point, month over month, 8%. So it took quite a thing for inflation to be this high. So it's not going to just disappear overnight, especially with China still kind of facing lockdowns and not reopening fully the country. And with that, you can still expect supply chain issues to have a lot of weight into, the CPI, inflation and the CPI result for the month of September. So as a whole, we are seeing that maybe we can get to that place where things started to get normalized a little bit while we're waiting for inflation to start, falling as quick as we want, even though that's really, maybe a dream. All right. Now, all of this means we can still have stocks continuing to rally. Now, what does it mean for you as an investor? Well, if you're long-term, as I am, with your 401k, Roth IRAs, or, retirement accounts, then it doesn't matter. As a matter of fact, it's a good thing, because the longer we stay in these kind of low prices of stocks and paper assets kind of phase, as you are continuing to buy on a DCA base, whether it's weekly, bi-weekly, or monthly, then you're acquiring as much shares at a low price. All right. And whenever we get to the other side of this thing, because we're going to get to the other side of this thing, then prices are going to continue to go up. And that's where you build true wealth. All right. So nothing to change there. Now, if you are also like me, where you want to take, advantage of some low prices into good quality stocks, and then you buy low and then you sell high, what we call swing trading, then I think right now it's a little bit too early, in my opinion, to do so. Well, again, depending on the type of stocks, the sector where you are. All right. For me personally, I'm in real estate, in energy, and also really big into the mining stocks and crypto. All right. So those are my two key sectors that I'm playing in order to make, these swings. And I see that the midterms, or after the midterms, if the market continues to rally, then maybe we can get to that point where it's time to sell. Another reason why I think it's too early to kind of, sell if you're swing trading or if you're playing with the market, it's because of this index, the fear and greed index. We are still in neutral phase right now. Whenever it's time to buy, there was extreme fear, and that's when we bought. But when it's time to sell is really when we are kind of in here, greed or extreme greed, and we are still not there, meaning I can confirm or I can agree with this article stating that there is still a lot of room for stocks to continue to go up. Nothing guaranteed, because nobody can expect what the market will do in the future, but at least signs are there and indicating that, we might be onto something here to make a lot more money in the next coming months or possibly weeks. So let's stay tuned.